Hello everyone, I'm Asian Guy. Over the past few years, something unusual has been happening across global financial markets. Not a crash, not a panic, not even a clear trend that makes headlines. Instead, we've seen assets that are supposed to behave very differently begin to move in ways that quietly contradict the official narrative of stability. Capital is flowing, but not chasing growth. Liquidity is present, but it's becoming selective. Long-term investors are no longer responding to reassurance. They're responding to credibility. This matters far beyond any single market or asset class, because when trust in institutions erodes, it doesn't collapse overnight. It thins, it fragments. And by the time the public notices, the structural damage has already been absorbed into prices, policies, and expectations. What makes this moment urgent is not volatility, but the absence of it in places where stress should already be visible. And when you look closely, you can see signs that large institutions are quietly repositioning, not for opportunity, but for resilience. That's what we're going to examine today. Before we go further, subscribe right now, because what you're about to hear explains a shift most investors still haven't noticed. Let me start by grounding this discussion in observable market behavior, because institutional trust doesn't erode in speeches or surveys. It erodes in allocation decisions. It shows up in how capital moves when no one is watching. Over the last decade, we've lived through an environment defined by unprecedented monetary intervention. Rates were suppressed, balance sheets expanded, and risk was systematically smoothed. For a long time, that worked. Markets believed in the competence and coordination of institutions. But trust is not built on outcomes alone. It's built on consistency, transparency, and limits. And those limits have been tested. Look closely at long-term price structures across traditional safe haven assets. Gold, for example, spent years consolidating after the post-financial crisis surge. That consolidation wasn't random. It reflected a market trying to reconcile two opposing forces: aggressive monetary expansion on one side and institutional assurances on the other. For years, reassurance won. Real yields were negative, but credibility held. Now notice what quietly changed. Gold didn't explode higher in a speculative frenzy. Instead, it began to grind upward during periods when policy messaging emphasized control. That's not fear-driven behavior. That's trust-driven behavior reversing. Now look at silver. Silver is not just a monetary metal. It's industrial, cyclical, and volatile. Historically, silver only outperforms gold when growth optimism is strong or when monetary stress becomes undeniable. But recently, silver's behavior has been uneven. Periods of sharp interest followed by long stretches of apathy. This pattern doesn't appear often. We've seen it before, but only during stress periods when markets are unsure whether they're pricing inflation, recession, or institutional fatigue. The gold-silver ratio remaining elevated for extended periods is not just a comment on growth expectations. It's a signal that confidence in coordinated policy outcomes is weakening. Let me walk you through the numbers. Over the past several years, ETF flows into precious metals have become more strategic and less reactive. Instead of sharp inflows during crises and outflows during calm, we've seen steady accumulation during periods of apparent stability. That tells you something important. Institutions are no longer waiting for confirmation from headlines. They're responding to long-term risk models that incorporate political fragmentation, fiscal dominance, and policy credibility. This isn't about inflation prints, it's about governance. Now shift your attention to volume behavior. In equity markets, participation quality has deteriorated. A larger share of daily volume is driven by passive flows and systematic strategies. That creates the illusion of stability, but it also masks fragility. When trust in institutions is high, active capital is willing to absorb shocks. When trust erodes, passive structures amplify them. The absence of volatility today is not proof of resilience. It's evidence of deferred adjustment. This is where it becomes important to distinguish between paper markets and physical constraints. In commodities, particularly metals, paper markets can expand indefinitely. Physical supply cannot. Mining investment has been constrained for years, not because demand disappeared, but because long-term confidence in price signals declined. When institutions signal that prices will be managed, capped, or stabilized, capital withdraws from long-horizon projects. That creates supply rigidity. And supply rigidity is not inflationary by itself. It becomes inflationary when trust breaks. Look at industrial demand trends. Silver is embedded in energy transition technologies, defense systems, and advanced electronics. These are not speculative industries. They are policy-driven. And yet, investment in supply has lagged. Why? Because policy-driven demand without policy credibility creates uncertainty. Firms don't invest aggressively when they're unsure whether incentives will persist. This is institutional trust eroding at the operational level. Now consider the US dollar. The dollar remains dominant, but dominance is not the same as confidence. Reserve currency status relies on trust in rule of law, fiscal discipline, and institutional continuity. Over time, we've seen central banks diversify incrementally, not dramatically, quietly. Gold reserves increasing in jurisdictions that publicly support the existing system, but privately hedge against its strain. That behavior doesn't show up in daily FX charts. It shows up in reserve composition over decades. Interest rate expectations tell a similar story. Markets price cuts and hikes, but the deeper signal lies in real yields. Real yields reflect confidence in future purchasing power and policy credibility. When real yields rise, but long-term inflation expectations remain anchored, that suggests trust. When real yields rise and inflation expectations become unstable, that suggests skepticism. Recently, we've seen oscillation rather than conviction. That's a sign of institutional fatigue. Historical parallels matter here. In the 1970s, institutional trust broke visibly. Inflation was high, policy credibility collapsed, and markets reacted violently. Today is different. Institutions learned from that period. They manage perception more carefully. But trust erosion doesn't require chaos. In Japan during the 1990s, trust eroded through stagnation and policy exhaustion. Capital didn't flee, it adapted. Growth slowed, risk appetite declined. The system persisted, but it changed. This gradualism is what makes the current environment dangerous to misinterpret. When trust erodes slowly, markets don't scream, they whisper. You see it in long-term underperformance of productive investment. You see it in rising preference for liquidity over return. You see it in the premium placed on optionality. Look closely at corporate behavior. Companies are buying back shares rather than investing in capacity. That's not just about cheap debt. It's about uncertainty regarding future policy regimes. Firms don't trust the stability of incentives. That's institutional trust erosion, translating into lower long-term growth potential. Now bring this back to capital allocation. Pension funds, sovereign wealth funds, and endowments are extending duration in real assets, infrastructure, and inflation-linked instruments. Not because they expect inflation to spike tomorrow, but because they're hedging against policy inconsistency over decades. This is slow repositioning. It doesn't move markets overnight. It reshapes them over time. But this is where it becomes systemic. Long-term economic growth depends on trust. Trust that contracts will be honored. Trust that policy frameworks will persist. Trust that risk and reward will remain aligned. When that trust weakens, capital becomes defensive. Innovation slows. Productivity gains diminish. Not because people stop working, but because they stop committing. And you can see this in the data. Trend productivity growth in advanced economies has been declining for years. Demographics matter, but they don't explain everything. Institutional trust does. When entrepreneurs believe the rules may change arbitrarily, they shorten their horizons. When investors believe returns will be redistributed or regulated unpredictably, they demand higher premiums or withdraw. This is not a moral judgment, it's a mechanical process. Markets respond to incentives and credibility. When institutions overextend, even with good intentions, they draw down trust capital. And unlike financial capital, trust capital is slow to rebuild. By the time this erosion becomes visible in GDP figures, it's already entrenched. Markets adjust first, then behavior, then outcomes. When we talk about the end of institutional trust, it's important to be precise about what that actually means. Trust does not disappear all at once. It degrades in layers. First, confidence in outcomes weakens. Then confidence in explanations weakens. Finally, confidence in intentions weakens. Markets are currently moving from the second phase into the third, and that transition has profound implications for long-term economic growth. Up to this point, many investors have framed inflation as a purely mechanical phenomenon. Too much money, not enough goods, higher wages, higher prices. But inflation at the systemic level is not just a price issue. It's a credibility issue. Inflation becomes dangerous not when prices rise, but when people stop believing that institutions are both willing and able to restore balance. Once that belief weakens, behavior changes in ways policy tools struggle to reverse. Look closely at how households and firms are responding today. Consumption patterns are becoming more defensive. Savings behavior is becoming more precautionary, even among higher income groups. Businesses are prioritizing margin protection over expansion. These are not reactions to a single economic report. They are adaptations to an environment where long-term predictability feels compromised. Currency trust sits at the center of this dynamic. Fiat systems function on confidence that future value will be reasonably stable and fairly administered. When that confidence is strong, people plan, invest, and defer consumption productively. When it weakens, optionality becomes more valuable than commitment. That's why we're seeing increased demand for assets that preserve flexibility, even at the expense of return. Central banks understand this risk, which is why communication has become as important as policy itself. But there's a limit to how much communication can substitute for credibility. When policies change frequently, when frameworks are revised retroactively, and when forward guidance is repeatedly invalidated by reality, trust erodes even if intentions are sound. Markets don't judge motives, they judge consistency. Institutional risk management has already adapted to this reality. Large allocators are no longer optimizing for peak efficiency. They are optimizing for survivability across multiple regimes. That's why diversification today looks different than it did 20 years ago. It's less about asset classes and more about exposure to institutional failure modes. Political risk, legal risk, and regulatory risk are now treated as core variables, not tail events. This shift has consequences for growth. Long-term economic expansion relies on productive risk-taking. It requires capital to flow into projects whose payoff lies years or decades ahead. That only happens when institutions provide a stable backdrop. When trust weakens, capital shortens its time horizon. Projects that require sustained policy support become less attractive. Innovation slows, not because ideas disappear, but because the environment no longer rewards patience. Investor psychology during slow systemic erosion is subtle. There's no mass capitulation. Instead, there's disengagement. Fewer people believe that effort will be rewarded proportionally. That belief doesn't vanish overnight. It fades. And as it fades, productivity growth declines almost imperceptibly at first, then persistently. This is why headline GDP figures can remain positive even as long-term potential deteriorates. Growth becomes consumption-driven rather than investment-driven. Debt fills the gap. Institutions respond by intervening more aggressively to stabilize outcomes, which temporarily works, but at the cost of further trust depletion. It's a feedback loop. Historical examples are instructive here. In late-stage Roman economies, growth didn't collapse suddenly. It stagnated under administrative complexity and fiscal extraction. In post-war Britain, institutional credibility weakened slowly through currency crises and policy reversals, leading to decades of underperformance. In each case, the issue wasn't a lack of resources. It was a lack of trust in how those resources would be governed. Today's global economy is more complex, more interconnected, and more technologically advanced. That provides resilience, but it also increases sensitivity to trust breakdowns. When institutions are highly leveraged, financially and reputationally, small credibility losses can have outsized effects over time. This brings us to the central implication. The role of certain assets within the financial system is changing, not because of ideology or fear, but because of function. Assets that anchor trust, preserve optionality, or sit outside discretionary control gain importance in environments where institutional credibility is questioned. That doesn't mean abandonment of the system. It means hedging against its limits. At the same time, traditional growth assets face a more challenging environment. Not because growth is impossible, but because it requires alignment between private incentives and public frameworks. That alignment is harder to maintain when institutions are stretched by debt, demographics, and political fragmentation. Long-term economic growth is ultimately a social contract. It depends on the belief that effort today will translate into security tomorrow under a stable set of rules. When that belief weakens, societies don't collapse. They adapt downward. Expectations reset. Ambition narrows. Growth slows. This is the quiet risk markets are pricing today. Not disaster, but decay. Not collapse, but constraint. Capital is still moving. Innovation is still happening. But the trajectory is flatter, the confidence lower, and the margin for error thinner. So when you observe unusual market behavior, resist the urge to frame it as a trade or a prediction. Instead, see it as information. Information about how trust is being revalued. Information about how institutions are perceived. Information about where long-term growth is becoming harder to sustain. To summarize, we've examined how institutional trust erodes gradually, how that erosion shows up in market structure and behavior, and why it matters for long-term economic growth. We've seen that this process doesn't rely on crisis or panic. It unfolds quietly through incentives, credibility, and adaptation. And once it's embedded, reversing it requires more than policy tools. It requires rebuilding trust itself, which is slow, uncertain, and politically difficult. The financial system is not breaking, it is changing. And understanding that change is essential because it shapes how capital behaves, how economies grow, and how societies plan for the future. Thanks for watching. Subscribe, share this, and stay alert. Because what's happening right now matters more than most people realize.